Welcome back to VADA Live. I'm your host, Dan Kerrigan. Today we're catching up with a familiar voice with Virginia's dealers. That is Kevin Tynan, Director of Research at the Presidio Group. Kevin, we know you spend your time tracking the forces shaping automotive retail, from manufacturing strategy, trends, economics, dealership operations. And judging by a recent LinkedIn post you had sent out, Kevin, it seems like you're already thinking about VADA 26, something about a cassette tape and a drive down. Welcome back to the VADA Live, Kevin. Let's start there.
Yeah, look, I always, that's always circled on my calendar, the Virginia event. For one of those reasons is that I can usually drive there, which I love to do. You know, I have my little convertible. It's in June, put the top down, hit the road, some sunshine, some good music, some good friends when I get there. So very, very much looking forward to it. Not even just from the professional perspective, but just connecting again with people and the relaxation of a good long drive in a great car.
And it's a beach trip at that this year, Kevin, at Virginia Beach. Getting to the issues, so you spend days, your weeks, your career studying the industry at various angles. As we sit here in 2026, what are the biggest trends shaping up for the year, the landscape right now as you see them?
Yeah, I think, Dan, this is a year, at least as it starts, with really getting back to the basics, right? The financial physics of the industry. And for me, that gets right back to supply and demand. Where are we in that cycle? 2025, we saw tariffs, right? We saw the expiration of the federal EV credit, right? That did some funny things to demand, pulled some demand forward. None of those are on the horizon. You know, they come out of nowhere, and the dealer base is always prepared for that. But this is a year that it looks to me like understanding where we are in that production cycle from the OE perspective, where demand is, and then where pricing and margins fall within that relationship is really what I'm looking at so far.
Data, can we dive in a little bit? What are you seeing at this point, and what signals should dealers really be paying closest attention to over this year?
Yeah, I'm talking about the supply side first, right? I think demand can be manufactured from the perspective of if you throw enough money at the consumer, they will step off the sideline and buy vehicles. So I'm usually less concerned about the creation of demand. There's plenty of ways to do that. I think if I'm a retailer right now, I'm watching my OEM partners and saying, okay, what's the mindset here? Is it a ramp of production? And if it is, I'm a little bit concerned about pricing power and margin going forward. And if it's a pullback in that production, I'm expecting that I'm going to do less volume, but I'm going to do it at higher prices, firmer revenue per vehicle, and wider margins. So I think it's important for the base to understand the mindset of your OE partner in this environment or in this cycle, and you'll sort of be ready for what's coming. And look, the trend for years, if not a decade plus, Dan, has really been fewer units, higher transaction prices, which has created a little bit of an affordability concern. But ultimately, the industry has grown in the past several years from higher prices, not from more volume. And I think that trend continues.
And Kevin, can you help sort something out for me in my non-automotive expert mind? I'm hearing a few things, and through the past year, affordability, we know about that, the issue. I'm also seeing things where luxury brands are having a moment right now, K-shaped economy being the elephant in the room. Can you help me unpack that a little bit and what that message sends? Where should consumers and dealers be thinking? What does that mean?
Yeah, and I'm just doing a bunch of work on the affordability concept, and some of it is a little bit contrarian or counterintuitive to where we are as far as affordability. I think if you do the math certain ways, there is no lack of affordability relative to everything else, relative to inflation over the past 25 years, relative to the mix shift in the U.S. auto industry to trucks from cars, that pricing is relatively the same. Arguably, it's better than it was. And I use 2016, the peak volume year, as a benchmark, and say affordability is actually better than it was a decade ago. It doesn't feel that way. And it can be about incomes, right? Might not have risen as quickly as everything else, but relatively speaking, affordability, I don't think is the problem that it's made out to be. I think several things though, Dan. One, obviously that $50,000 average transaction price is a big, round, scary number, something we've never seen before. And I think it's natural to think, oh my gosh, I never figured I'd pay $50,000 for average for a new vehicle. Look, and the other thing is, I will tell the dealers it's not coming back, right? If you think about that inflation, the cost inflation of being a manufacturer, your raw materials, your labor, your logistics, your distribution, all those costs perpetually increasing, the answer to that is not cheaper vehicles, less expensive vehicles. It's actually the opposite. And those are the financial physics I was talking about earlier. And that's what's playing out now. So if I'm a retailer or I'm telling retailers, don't be making calls to the CEOs of your OE partners saying like, hey, we could really sell a ton of $25,000 vehicles, because they're not going to do it. You just can't get the volume heft at that low or narrow of a margin or negative margin that you would actually want to do something like that. The answer is to go the other way. We'd rather sell two $60,000 vehicles, than three $20,000 vehicles and one $60,000 vehicle, right? Margin-wise and revenue and profit, revenue contribution might be the same, but the profit profile is very different, and the industry has made an orchestrated move in that direction, and I think that continues.
Thinking about that pragmatically, how should dealers adjust? Putting my consumer hat on, I'm still looking at something that is expensive. I'm not seeing it within that macro.
Right. Now, those two seats you just mentioned are very different. The consumer is going to have to look for bargains, maybe in the used vehicle space. There are still, like I said, there still are affordable vehicles out there, relatively speaking. But the brands that are typically not affordable, whatever that definition of the word affordable means, or have moved away from affordability, aren't coming back to it. So you're going to have brands who have good product at the entry and move up segments, and they will continue to have those products for the time being. But the consumer view is you're not going to get, Cadillac, Mercedes, BMW, any of those luxury brands becoming affordable. You're not even going to get the mid-level brands becoming affordable again. The ones that have been affordable will continue to be so. But then the view from the dealer is exactly that, is expect and align your cost structure for lower volume, but bigger revenue per unit, right? So if that means, I think it's really going to come down to managing your operating expense lines. The days of bigger gross profit they may come back, but they're not imminent right now. I think the big gross profit gains were during the pandemic when supply and demand was very tight. Now supply chains are not disrupted anymore. There's a good flow of materials and products and production. So that front end gross is going to be the challenge. The trick is going to be keeping more of that gross profit, and you're going to do that on your operating expense lines. So there's going to be software solutions, just efficiency, productivity from your workforce. It's going to be in those areas where you're going to keep more of your gross, not that you're going to make more of the gross.
Appreciate you entertaining that question, Kevin, and making that actionable for dealers. One thing I wanted to ask you about, we had discussed this before about franchise dealer model continuing to be resilient throughout the 2 years now we've been having these interviews and chats with you. What factors do you think are reinforcing the franchise model right now?
Well, and that's another thing I'm doing a lot of work on, and I'll have a section on that at the convention. It's one of those things that I find very difficult to understand from those different seats.
Sure.
Now, I understand if from the consumer's perspective, if you say, well, pricing, we walk into a dealership and we don't know what pricing is going to be, and it's flexible. And I'm saying, but when I run those numbers, there was 1 year, which was 2022, where the consumer averaged over MSRP. So if I go back to 2018, for example, the consumer, the discount from MSRP, and I'm going to use MSRP because I'm going to assume in a direct sales model, that's what the consumer is going to pay, right? You're just going to go online, you're going to click MSRP, I'll take it. The consumer from 2018 through 2025 has saved off of MSRP $194 billion. Comes out to be about $1,500 per vehicle, and that includes the period during the pandemic, which 21, 22, and 23 were basically even. If you take the pandemic out of it, it's about $2,500 per vehicle. So the question I would ask the consumer is, so are you saying you would rather not have to deal with a franchise dealership but just pay $2,500 more for that same exact vehicle and say, no, I'm happy to do that? Because I don't think that's the answer, right? So the idea of this price flexibility is has been to the advantage of the consumer for every year except for one. So from that, I'm trying to decode that. From the manufacturer's perspective, look, you're booking that revenue on the sale to your franchise dealer partner. If not, if they don't exist, that's on your balance sheet, right? That's finished goods on your balance sheet. No offsetting revenue. If you can't sell or deliver to the public everything that you build, that's on you now, right? So financially, from an accounting perspective, it doesn't make a ton of sense to me. And when the manufacturer, if the idea is like, well, we'll cut out the middleman and we'll make more money, I'm saying, I don't know that you would be, right? If you're saying we're going to discount by 6% to sell these vehicles to the dealer and then they do what they want with them in terms of pricing, I don't think that the manufacturer could become or replicate the franchise dealer model, logistics, distribution capabilities, experience for 6%. And then the other angle, thinking about it from the dealer's perspective, if the OEM came to me and said, hey, we'll just give you 6% for everything and you don't have to carry inventory, I think, dealers might say like straight line 6%. Yeah. But I think the problem there becomes when it's not 6%. Oh, okay. How about we do 4? How about it becomes 3? So that's a Pandora's box you don't want to get involved in. So for me, I think the emotion of a direct sales model from the consumer's perspective or from the OEM's financial perspective seems obvious, but I think you're only thinking about it to the end of your nose. You're not really getting into the unintended consequences and the implications of changing that model to something else. It doesn't make sense.
Global competition, especially with Chinese manufacturers. And for those watching and listening, if you have not read Don Hall's recent leadership message on this, please, it is a must read on VADA.com. Question for you, Kevin. How real is that competitive pressure with U.S. market? What should dealers be watching for?
Yeah, and again, there's another one. Depends on your seat. If you're the consumer and you say, boy, I could get pretty competitive vehicles very affordably if we let China in here. The other side of that trade is, yeah, but you may be getting cheap products, but there goes our manufacturing jobs, right? And that's the thing that people aren't thinking about as much, right? I'd rather have the cheap Chinese good than a manufacturing base in this country. And I think that's scary, right? That's something that needs to be considered. From the OEM's perspective, it's very scary, right? Because arguably that's a zero-sum game, which is meaning we are a mature market, and let's call that 16 million units a year. For everything that is imported from China is something that doesn't get sold from an existing OEM in this space, right? So if they come in and they take 10% of the market or 15% of the market, 2 million vehicles, there goes some market share from somebody. From the OEM perspective, that's very scary. The dealership, probably not as much, because it would give you some new hot brands to sell. Your existing OE partners would lose some volume, But at the end of the day, I could see that making up for it. Again, if we're a mature 16 million unit market, we're just going to cut the pie differently. And those dealers that are franchises for Chinese brands would offset the losses from one brand and make it up in one of the Chinese brands. So again, very different perspective. And again, there's a foot in the door, Pandora's box. That's a little bit scary there too, from every perspective, that the Chinese manufacturers, and look, even I'll throw in a fourth perspective, which would be from the government perspective, which is to say, I could see where an administration says we're going to implement the same rules on Chinese manufacturers that we have when we try and build over there, which is you bring the factory here. You hire our union workers. You reinvest those profits in this market. You don't mail them back home. You can build here and export. You can't import anything. And I can envision the day where an administration says, look what I did. I brought manufacturing to this country. I put more people to work here. And arguably, it would be Japanese manufacturers coming after World War II, right? They're here, they build factories here, they employ workers, they're contributing to the economy. It would be that same kind of thing. I think the exports, first and foremost, the imports would be the scariest part. You can't just become an importer of Chinese vehicles.
May we chat fixed ops for a second? And we know they continue to be key drivers for stability for dealerships. Anything you're seeing with the numbers, any strategies among operators that are doing it well?
Yeah, and I think that's part of the pivot I've been writing about since during last year or even earlier, which is to say, again, that front end gross on new and used vehicles is going to become increasingly difficult. Excuse me, on new, it's becoming difficult. On used, it's remaining to be difficult. So you have that pivot, right? Fixed ops is a big margin business. It's a huge addressable market of which the franchise base doesn't get the majority of. In fact, it's probably closer to a quarter or a third of that U.S. auto care market. So there's great opportunity at 50 plus, almost 60% gross margin there. It's really where the business is. And again, as front end gross gets difficult on vehicles, new and used, that's going to be the place to turn. Also with finance and insurance, warranty, those kind of things are going to become a bigger part of the gross margin, gross profit pie. And then, as I said earlier, what you want to do is be able to keep more of that pie. Right, so more of it's going to come from fixed ops, F&I. Now the question is, what tools are out there? And it's a great time in terms of technology and tools to really get efficient on your operating expense lines and keep more of that gross. So there was a period, the pandemic specifically, where it was really easy. New vehicles came in the morning, they were out in the afternoon, and they were gone at 13% front end gross margin, and it was great. It's not that world anymore, right? So that's the pivot that I'm talking about. It's like great while it lasted, but now you really have to start to focus on those other business units, and you have to figure out how to make those business units more, expand the margin and make them more efficient, better productivity out of those. And the tools are out there to do that. And that's what we'll see. A lot of the vendors at the convention will be talking about this specifically and have products for this specifically.
Just to make sure I'm putting and interpreting this correctly, and a finer point on it, Kevin, if I'm a dealer who thinks, hey, maybe the pandemic surge is going to happen again soon, I'm holding out hope for that. What do you say to them?
Yeah, no, I look, and it's interesting, and I wrote a piece, I'll probably have a slide or two on it and talk about it. Very interesting. So before the pandemic, really, arguably since the beginning of time, you got better front end gross margin on used vehicles than you did on new vehicles, just the way the business was, right? And you could say that new vehicles are essentially commoditized, right? What one dealer sells is the same as the other dealer because it's coming from the same manufacturer. Used vehicles are a little bit more like a snowflake or a fingerprint where everyone is different. Mileage, condition. So it lent itself to a wider margin for used vehicles. That flipped 21, 22, where the front end gross on new vehicles became higher than it is on used vehicles. And you say, okay, we understand that because supply basically went away of new vehicles. And you go back to those financial physics that have been in place since the beginning of time. Supply demand very tight, prices go up, margins get wider, and that's what happened. The interesting thing is I think we could argue that the pandemic period is over. That margin has not flipped back. New vehicle front end gross is still higher than used. And to me, that's very interesting. And I wonder, and in the piece that I wrote, does it flip back? Is there a world where it doesn't flip back, where, there's so many used vehicles now because prices are higher that it just becomes a low margin, high volume business the way financial physics work, right? The more supply, the lower the margin. Now, when we move to higher prices on new vehicles and we constrain the output, they become the lower supply factor here, and that margin ends up being better. So sort of the question that I'm addressing in the piece is, could this be the new normal? It's not a term I love, but that new vehicle gross margin actually, now that it has taken the lead from used vehicle, it stays that way, if not indefinitely, for an extended period. And that's kind of what's happened so far. So, it's not going back to double digits anytime soon without manufacturers completely compressing or muting their output to the level of demand. And we know what that level is, right? I've done that math, which says over a very, very long period, we average 1.3 million units a month. Inventory somewhere north of 3. If we brought them in line, could we get back to double digits? Probably, but I don't see manufacturers going that conservative on output.
Kevin, one of these segments, we're going to do a screen share session with your math and Excel spreadsheets and macros, and that's going to be a fun discussion. Let's get that on the books at some point. It's maybe one final question, Kevin. So when you're talking to dealer groups, which you do around the country, is there anything we're not talking about right now? Are you getting certain questions? What are you hearing?
Yeah, I think those 2 points, right? China is more of a not necessarily today problem, but there's concern there, how to address that or how to think about it, or as I said, how to be in position for that when it happens. The other one is this affordability question. Like I said, if you do the math a certain way, I can make the argument that affordability isn't really a thing, but you do have dealerships who, I talk to dealerships and they say, look, my stores are in a county where household income, $50,000 doesn't work, right, for a new vehicle because the household income is not much higher than that, right? And that's a reality. And then you say, well, what do I do? And the answer is, well, you probably need a store that sells affordable vehicles. Because again, waiting for your existing stores that don't have affordable vehicles to get affordable is not going to happen. And maybe, to tie those two together, that's some of the risk with the Chinese brands is that they become the affordable part of the market. And it's that scary foot in the door, Pandora's box we talked about. I think the fear is that that's not the only part of the market that the Chinese manufacturers would want, right? They would start there, or they could start there, but they want all of it. And then the other thing is, I think it's less of a question now. A lot of it got resolved was the electric vehicle. Like, what's the strategy there? We made investment in this technology, and now we're hearing that it's all, it's being written off, it's written down. What's the strategy going forward on electrification? And I think there will be a place for it. It probably has to happen, but at a much more controlled pace than I think what was put out in the early stages of it. And that's a whole nother presentation and discussion, is whether it makes sense, whether that's a narrative put forward by Chinese manufacturers because they control that supply chain, and that's where they need their transportation and mobility industry to go. And they've convince the rest of the world that's where it needs to go. So there's a lot to unpack there too. But those are probably it. Is really and I interpret that, Dan, as talk to me on where we are in the cycles. Again, those financial physics, like I joke, have been in place since we were trading stone wheels for saber-toothed tiger pelts. Right? Too many of one and the price goes down, and not enough and it goes up. And understanding where we are in that part of the cycle it's half the battle for the retailers in the dealerships in terms of what do I do, right? And I think that's the beauty of the convention, is that there's a lot of people there, speakers, presenters, vendors, that can provide actionable answers for the franchise base.
Well, you've been hearing from Kevin Tynan, Director of Research at the Presidio Group, who is a speaker at this year's convention, VADA 26 in Virginia Beach at the Marriott Oceanfront Resort, June 22nd through the 25th. If you have not registered. If you have not found out about the amazing information, activities, speakers, and other things planned for this year, visit VADA.com for those details. We thank you for watching VADA Live. I'm your host, Dan Kerrigan, and we will see you next time.